Folks, I'm just teaching you banking here, but you know what I'm also teaching you? How you can be the bank. It is no different.
It's basically just a strong financial foundation.
You set the rules, you set the terms, you set the repayments, you set every single rule for your banking system because it is your money. I'm just teaching you to do what a bank does every single day, folks. And I'm trying to teach you how you can teach your children by just starting with simple things like an acorn or whatever seed you want. What's going on, everybody? Another week, another wealth webinar. Honored to be here, honored to share with you what we've learned over our journey, and what you're going to learn is literally the truth about money. The things that you will never be taught in school, in college, the things most of your financial advisors will never tell you about. That's what we're going to get into today, and we're going to literally take this one back to the drawing board. And I had some ideas this morning. I go for runs or I go to the gym every morning and I get all these ideas. Well, today, when I came home, I jumped in the shower and I got this great idea. And I literally got out of the shower soaking wet, wrapped a towel around, ran downstairs. Larissa's like, what are you doing? You know, and anyway, I jotted them all down. So I want to I don't have the final conclusion. I don't have the final thing for what I came up with, but I'm going to lay it out for you all today. It's so simple, but it's so direct in what it does. And then what we're going to do is Craig and I are going to launch it and release it this weekend for our, we do one of the best financial trainings in the business. It is the 3-day Money School Essentials, which we are doing this weekend, Friday, Saturday, Sunday. So I wanted to get everything done with what I came up with in the shower today, but I couldn't finish it. So I'm going to lay it out. And all of you that join us for the 3-day, which will make a very special offer today, for any of you that want to join us this weekend, you will see what that was. But let's get right into it. So when we're talking about money, we always have to understand that money is nothing more than a tool. It's just like the shovel in your garage, the rake, whatever you have in your garage. Tools are built to solve specific tasks. Now, money is kind of like the Swiss Army knife, if you really think about it. It solves a lot of different things with one thing, and that is money. But money isn't anything more than a means of exchange. It's just something that we use to exchange. You know, we go out there and we work for this stuff. And then what we do is we exchange it for goods and services, for coffee, for a bag of chips, for, I don't know, a Red Bull. That's all we do. We make money by trading hours for dollars, because that's what we've been taught to do. And then we take the money we make when we get it, we exchange it for various things. That's all money is. But if you make money anything more than that, you're getting outside of the realm of what it was created for. It's just an exchange. And money could be, I mean, back in the day, it was all sorts of things. It was gold, it was silver, there was paper, there was IOUs, there was all sorts of things throughout history that have been used. But here's the most important thing. We need to understand that money is not a limited resource. It's everywhere. And if you want to get more money, all you need to do is disrupt the flow of money. That is it. Remember, money's an exchange, all sorts. It's always moving, always going here, going there. It's an exchange. So you want to get more of it, you got to disrupt it. I'll give you an example. This webinar right now, there'll be over 100 people on here. We are going to disrupt people's thought patterns for how money works. That's a disruption, okay? Money is always flowing. Now, I'm going to bring this back, and I want to talk a lot about today how I would explain privatized banking, BYOB, the infinite banking concepts as R. Nelson Nash pioneered it. I want to explain that like all of you are my daughter. My daughter's now 4 years old. She's pretty articulate. She draws a lot of pictures, but literally, how would I explain it to my daughter? And how would I explain it to your son or daughter? That's what I want to get to. But let's go back to money being a means of exchange. So when we take the money we earn, we typically will take it and it has to go somewhere. Now, our starting place for everybody on this, I'm just going to start at a common ground, is a bank. Okay, I was late coming into this webinar because me and my wife were at a credit union because I am literally done with commercial banks. I'm literally drawing the line in the sand right now. I am done. I found a community bank, or I'm sorry, a credit union that I've done business with since I was a child, and now they've expanded into the business world. I am basically shifting all business there. Now, when I'm sitting down with the girl today, with Larissa, her name was Jen, and I said, Jen, I want to be honest with you. There are millions of dollars that will flow in and out of this bank through these accounts that we're moving over here. However, I never leave much money in the bank. And she says, we don't care. We just care about the relationship. Right answer. Because I don't leave money in banks. Banks just get the money that I earn and I put it there. And it's sort of like almost like an overnight exchange for me. It's like the money stays there until I can figure out where I'm going to put it in my private banking world. So how I want to start this with is if I were talking to one of your children, here is how I would basically start the description. So I'm just going to, if you might, I'm just going to draw a little piggy here. Okay. I'm just going to draw a little piggy. There's my pig. All right. And, you know, we're just going to call this the piggy bank. So we teach our children to deposit money into their piggy banks. I mean, come on. How many of you, when you were a child, were taught to deposit money into a piggy bank? You all were. And what were you shown that that piggy bank would do? Well, it would accumulate. Over time, that piggy bank would begin to fill up. And eventually, well, mine used to have that little thing on the bottom, that little rubber thing you pop out, and then all the money comes out the bottom, but you put one in, and then all of a sudden, when you take it out, there's more than one that comes out. It's because you were saving. But you see, the piggy bank did not offer any compound interest. It was just the money that you worked for that you saved. So let's just say you wanted to teach your children how this works. What you would first do is explain the importance of saving money, and always start with the minimum. As the richest man in Babylon, the book referenced, okay, they talked about gold, but we're going to move it into the laws of wealth. Law number one, or rule number one of gold, as that book said, was save 10% of what you earn. Now, 10% of gross. Now, a lot of people are like, oh, I save 10% of my net. No, 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 you're gross. So let me just ask everybody that's on here right now, how many of you have children? Put I in the chat. How many of you have children? And as they start coming in, I'm pretty sure it's almost all of you, how many of you have literally made a conscious effort to talk to your children, to teach your children to save money? Be honest with yourself. How many of you have actually made a conscious effort to sit your children down and to teach them about money? Put yes in the chat if you've made a conscious effort. Because listen, there's no right or wrong way to do this. So I want to kind of just see, I love this. This is the right kind of group. My son teaches me. That is freaking amazing. But we got to start somewhere. And usually the best place to start is just teach them the importance of saving. And how you can teach them the importance of saving, especially at my daughter's age, is here's how I would explain it. My daughter, I'm starting to teach her a lot about growing food and how things work. Like she's in that why stage here, right? Everything is, well, why, Daddy? Why, Daddy? And, you know, when we're outside, I show her the beautiful flowers. I've got her used to smelling flowers. I'm teaching her a lot about bees and like the little dandelions, you know, so she loves dandelions. We walk through the yard. She's like, oh, there's a flower. And I'm like, don't pick it because the bees need that and they're not done with it. But I'm teaching. And then she starts asking, you know, where these things come from. Like, how do we get apples? How do we get peaches? Like, where does all this come from? And I started teaching her about seeds. So she's got this weird thing. When she eats an apple now, she'll take all the seeds and she'll put them aside. And she'll say, Daddy, can we go plant these? Because she wants apple trees. So let's just start over here. Okay, let's just say I taught my daughter about acorns because they're kind of a cool little seed. They look like this, right? How many of you know what an acorn looks like? Hold that thought. Stephen, take over real quick. I'm going to do something kind of cool. Stephen, can you explain to them what we're doing this weekend for the 3-day event? And also make them just a ridiculous offer to show up because they got to be there for this. I'll be right back.
All right, cool. Yeah, so what's up, everyone? I'm Stephen Naugle, and we do have, like Chris said, one of the top financial trainings that's out there right now. So we've been putting this on for about 4 years. It started as a live in-person event that we were teaching on a Friday, Saturday, Sunday, long weekends at a hotel ballroom in different parts of the country. And obviously we were doing that prior to COVID. And then when COVID hit, we made it all virtual and we realized, hey, we can fly in some of the top experts in different areas of financial strategies, some of the people from our network that we've known, but couldn't come to other places. But because of Zoom nowadays and being virtual, we can bring everybody together for 3 full days, still get the interaction with Zoom, still be able to respond and chat and everything just like this. But the cool thing is we can fit it now all into 3 days and do it very, very, very inexpensive. So what we decided to do is for the full 3 days, it's $297. You get the full recordings. We send you the recordings after each day that are time stamped, so you can go watch specific sections again. You keep the recordings for as long as you want to access the recordings. We give them to you.
I bet you some of you will say, oh, I wish I could make it this weekend. I've got a graduation party. I got this, I got that. No problem. We record every single day of the 3-day, edit it into segments so you can just watch just the part. So if you wanted to just watch the part we do about retirement and how you can retire early with tax-free income, it's wild, folks. We're always pushing the envelope, trying to find new things to teach on how people can retire more efficiently with less risk and more income without paying the government. When you see what Craig put together for the retirement segment, which will be Friday, it'll blow your mind. We've never done that one before. We got another one we've never done before, and by popular demand, real estate. We're going to do a whole segment on real estate and using your private banking system. I've got a ton of experience. And then we're going to layer in, like I said earlier, that thing I got in the shower, which I'll lay out at the end of this training today, but I don't have like the conclusive evidence because we like mathematically proving things, but I'll do that day too on Friday. So, oh, we got a guest speaker too Friday. Heresy Financial's Joe Brown, superstar on YouTube, is going to be coming and doing a segment Friday night. Well, not Friday night, Friday after the event. It's a bonus session. But let's get back to your children. Remember, teaching your children, a bunch of you said you are. Some of you said we haven't got to that yet. But teaching your children, a lot of us do it with a piggy bank. That's how I started with Vivi. Since Vivi was 1.5, she has had a piggy bank. And we just put little coins in it, makes some noise. We open it up and we take them out. And then I started teaching Vivi, you know, that BYOB, that's what she learned first, be your own bank. And I say, you give me 1 and I give her back 2, because kids understand 1 and 2. They understand 2 is more than 1. And eventually, Vivi, now when she gives me 1 and I give her 2 back, she knows that's a good thing. If I give you 1 of something and I get 2 of something back, that's good. But how I'm doing it now is a little different. I've moved away from the piggy bank thing, but she knows the 10% law. Whether she articulates what that means, it doesn't matter. It just means that when you get money, you have to save it. She's got this like vault that we bought her. It's kind of like a vault thing. And she puts money in, it counts it for her. And then when she takes it out, she can load it back in and let it count it again. So she loves doing that. But this is what I went outside to get. Does everybody know what that is? It's an acorn. Okay, there's a cool story I heard a long time ago. And a lot of people a second ago were asking, I can't believe you're wearing an IUL shirt. I am wearing an IUL shirt, and it says Imaginary Unicorn Life, which is what every IUL policy is, an imaginary, fictitious future. So I wore the shirt special, but an acorn is not imaginary. This right here is an acorn, okay? This acorn could sit on my desk in my office for 20 years, and it will never change. And it will never, nothing will ever materialize of this acorn. So what I teach Vivi, when she eats an apple, when she has a plum, anything that has seeds, any fruit or vegetable, and we're starting to teach her this with vegetables too, because I did it with the tomato plant. We say, if you take this seed and you plant this seed in the ground and you tend to it, you can't just leave it alone. You got to water it. You got to watch it. You got to make sure that it's got the proper conditions, especially in the early years. And I always refer to Vivi about doing this. Like, let's just kind of draw this. You plant it in the ground, okay? And this is how I'm doing it. And believe me, folks, this isn't boring. I'm going to bring this full circle. You plant it in the ground. Now, once it goes in the ground, Vivi, it needs water. So it needs water drops, okay? So we got to make sure it's got water. And if it's got water, what that's going to do is it's going to allow this seed to start to grow. So then what I do is I show her, because I just take her around the other parts of the garden, and I just show her eventually it's going to be this little sprout, this tiny little sprout that's going to come out of the grass or out of the garden. And I said, that is when you know it's starting to work. So that same concept of planting an acorn is no different than planting dollars in your private bank. So Vivi now has 2 private banks. So let's just continue this right here. So what she's going to do is she's going to plant her money. Okay. She's going to plant her money. Now, she's not going to understand whole life insurance. She's not going to understand bank accounts. She's not going to understand any of that at 4 years old. And your children may understand it because they might be older, but they probably don't care. What they care about is what it does. What Vivi cares about with the acorn or the seeds that we plant or the tomato plant that's growing out of the compost pile, what she cares about is that it is becoming something. And and the biggest thing that she loves about it is when it produces fruit. So one of the most miraculous things I've watched with my daughter, and folks, I'm sure all of you have done something similar, is we planted raspberries. And this year, for the first time, we got raspberries out of it. And every day when I'm with her, I come home or we're outside, she's like, let's go check on and she just calls it the garden. Let's go check on the garden. And she's looking for raspberries or strawberries. Now, unfortunately, the animals are eating them before we can, but she's always looking for them, right? That's what gets her excited. So when you plant an acorn and you tend to it, this is just like your money. When you tend to the acorn, it will eventually materialize and start to be a sprout. And eventually it will become a mighty acorn tree. And I show her what that is. And that tree will then drop more acorns. But if all we ever do is take the acorn and put it on our desk and stare at it every single day, hope that it grows into something, pray to it, talk to it, do whatever, it will never become anything. Does everybody understand where I'm going with this? The acorn is your earnings. The acorn is your money. The acorn is your wealth. If all you ever do is just leave it somewhere, it will never become anything, ever. No matter how much you want it to, no matter how much you're told it's going to, no matter how much you hope it will be, it will not. And your children need to understand this, just like you do. You have to tend to the garden. You have to tend to your money. So how do you do that? Well, we're going to get into that. First off, if you were going to plant this acorn, would you want to plant this acorn in rocky soil? Would you plant this acorn in sand? Would you take it to the beach and plant it? Would you plant this acorn somewhere where it's not fertile soil? So one of the things I showed Vivi is when we made the garden, we had little garden boxes, okay? When we made it, we put really rich soil in it. And I showed her that the composter that we have, where we put all of our extra vegetables and everything, that's what makes really good soil. And it's kind of funny, by luck of the chance, we put a tomato in there, and now the tomato tree, or the tomato plant is growing out of the compost, and eventually we'll have tomatoes, and she will understand that is rich, fertile soil. Because we tend to the soil. We're always feeding the soil, giving it new nutrients, mixing it up, making sure that it's always going to be the best soil. So we always need the best soil. So what is the best soil for your money? Is it the traditional bank where most of your money goes? No. Putting your money in a traditional bank or any bank account and expecting anything other than pretty much nothing to happen is just lying to yourself. Because that's about what's going to happen. Nothing. You will literally become poorer every year because of inflation. So your money needs to be working for you in the right environment, just like an acorn needs to be working for itself in the right environment. This is how you teach your kids. You show them. You point to the tree and you say, that tree started from this. And we can create more of those trees by taking this and putting it in rich soil and tending to the soil. So where is this place, this really rich soil? Well, I will tell you right now see, here's the thing. Some of you aren't going to understand this, but here's the thing. None of you are going to believe that this is where your money should start. You're all going to, a lot of people, except for some of you who have been around this campfire for a while. If I told you that the best place for you to put your money is an especially designed whole life, most people, your advisors, your CPA, your tax advisor, all the people would tell you that you're crazy. They would. But if you got around multimillionaires and billionaires and you started asking them where the majority of their wealth starts, not stays, starts, you'd be really surprised. Watch my YouTube video, and it's called The History of IBC, the history of the infinite banking concept. And I go all the way back to the Rockefellers, the Rothschilds. So much so do I believe in what the Rockefellers did. Not who the Rockefellers are or the bad things they did, but what they did for their families in future generations, their legacy, that I licensed, me and Hannah Kessler licensed the rights to a book that all of you are soon going to have called What Would the Rockefellers Do? We just finished the foreword to it. That book is licensed by us, and we are going to be giving that book to every one of you. It is a phenomenal book. It is definitely a different kind of book than our book, Mapping Out the Millionaire Mystery, but it is a phenomenal book. And in that book, it talks about these fundamentals of where your money starts. So if you can get your children to understand what a seed is, that a seed eventually becomes a mighty oak tree or mighty acorn tree or mighty maple tree, whatever you're planting, you can then teach your children the same fundamentals about money that is important, that where their money goes first is just as important as what their money does in the future. So why would we start with a specially designed whole life? Well, I'm going to take a couple things from that book, What Would the Rockefellers Do? First off, when we're thinking about where our money goes, now I'm just going to use this credit union. This credit union that I'm moving a bunch of money over to from all my business accounts, just a lot of accounts. I don't keep any large sums of money in banks, but from all my accounts, I'm moving them all over there. The reason I'm doing that is right now, that bank has an intro offer of 5.25% interest on the money, anything over 25 grand. So what I did is I said, okay, I can do this many accounts. I can earn 5.25. That's motivation, right? How many of you would move your money to a credit union if they paid you 5.25? Put yes in the chat. How many of you would do that? Just one? Just Mary? Okay. Every day of the week. Okay. So all of you would very quickly take the time and energy to move your accounts, which is a little bit of work, over to a credit union. And just so you know, it's called Cornerstone Federal Credit Union. If any of you are local to the area, you would move your money over there for 5.25, which is indeed what they pay right now. Matter of fact, they have checking accounts that pay 2.25%. Okay, so you would all move your money because that's what you've been told to do with your money. But you see, what you fail to realize is even though they say that they're going to pay you 5.25, in the small print, there's a big word that says variable. Can anyone tell me what variable means? Joking, you already know. It means this rate can go up or down based on prime. And it's actually not based on prime. It's based on the overnight rates. And basically, this rate is really tied very directly to T-bills, treasury bills. But we know come September, or at least some of you should, if you've been watching my YouTube channel, you would know that in September, the Fed is more than likely going to start dropping rates. When the Fed drops rates, what do you think is going to happen to this beautiful 5.25 intra rate? It's going to go down, right? But how many of you would be psyched if you found a bank or just a place where you could put your money where it did not go down? It was not tied to anything in particular. It was just a fixed rate on your money. You put it there, and you never really needed to worry about it. It was just going to continue to pay that rate. That'd be way better than a variable rate, knowing right now that we're on the other side of the coin going to be going down. We're going to be covering this in depth in the 3-day training. We're going to talk a little bit about something called the uninverting of the yield curve, which spells disaster for the markets. I'm telling you that right now, because when the yield curve uninverts, which it already did, but then it went back inverted, it uninverted. That means that a recession is very close. Every other time it's uninverted, I could show you charts. I did a YouTube video, but we're covering it on the 3-day. It leads to a recession. So we know a recession or a weakening economy is always followed by the Fed doing what? Stephen, what does the Fed always do?
Fed is always messing things up.
Okay, what's the other thing the Fed always does when we're going into weaker economy or into a recession?
They're raising and lowering interest rates.
Yeah, they're going to reduce rates. So we can already know that's going to go down. But if you could find a place where you could put your money where it doesn't go down, that would be good. So let's just say you're telling your children that there was a better place where your money could go, where it will always earn a higher interest rate than what other people are earning. That's all they need to know. So you found better soil. So let's just say I'm just going to use 5.25. That was what the credit union is paying, but that is actually a little low for what all the whole life insurance policies that we use for privatized banking pay. I would say most of our policies are paying anywhere between 5.6 and 5.85%, which is far better than 5.25. And out of that, right now, I'll just use one of them, actually two of them, sorry. Two of them pay 3.25% guaranteed for your life. Forever for the contract. And as long as you live and as long as you have that policy, you're making 3.25. So that's number one reason. Number two reason, one of the things that you would want to teach your children is when you plant this acorn, a couple of the things that are going to be really important that you take care of is you want to make sure that the weeds don't overtake. You want to make sure that there's not weeds blocking. Here, let me get rid of my piggy bank. I'm running out of real estate here. So we're going to keep the 10% up because that's a very important number. But we also want to make sure that weeds don't start growing here. I need this here. Trying to make this as realistic as possible. That weeds don't start growing all around your beautiful acorn that blocks the sun. Because if we got a sun, well, we all know the sun gives rays, and that is necessary for the acorn to grow. Also, when it rains, we don't want the weeds to steal all the rainwater from our seed that we're trying to grow. So you're going to have to weed your garden. So we're going to teach our kids that you want to weed your garden. Now, what are the weeds in the financial world? What are some of the things that would interrupt or get in the way of your money growing? How about taxes? So if we had a place where we could grow our money on a tax-deferred basis, wouldn't that be good? Where there's no taxes while the money's growing. But then if we had a place where we could grow not just tax-deferred, but tax-free, so we could take money, so we'll just put tax-free loans or withdrawals to basis, okay? I'm just gonna put withdrawals to basis. That would be good. That would be good soil, it'd be a good place to grow our money. But what also if we had the ability to use that money? So over here, one thing with all plants is they produce some flower or some type of fruit, and a lot of times things that we can eat to survive. So when a tree or an acorn or a tomato plant is growing, every year produces its fruit, its vegetable, it produces something, and we can eat that. But when we eat the fruit or we eat the tomato, and this is how you teach your kids, when we eat the fruit, the plant will keep growing. The seed will keep growing. The tree will keep growing, even though we're eating the apples off the tree, even though we're picking the tomatoes off the tomato plant, even though we're taking the raspberries off the raspberry plant, the tree will continue to grow. You know what that is in money? That is compounding interest. But you see, a bank pays you compounding interest as well. You put money in the bank, they pay you 5.25% temporarily. That money compounds at that rate. And it will compound until you take money out. In other words, it will compound until you take the fruit off the tree. But then once you take the fruit off the tree no longer grows anymore. That's how a bank account works. But inside of a whole life policy, the compounding is uninterrupted because you can use the money without interrupting the compounding. So in other words, your fruit continues to grow and produce no matter how much of it you eat. You could go out there and strip the tree of every apple on it every single year, and the apple tree will still flourish. And every year, it will produce more apples. And a matter of fact, if you eat all the apples, it will probably produce more apples next year. Amazing how that works. So you want to teach your children, teach them relatable things, teach them how a seed turns into a plant, which then can turn into a tree, which then can produce apples and different fruits and different things we can eat or shade for us. All of those things are no different than money, but yet we want to disconnect from nature and not think that money works the same way as everything else. It's a universal law, folks. So all of these things are how compounding and how whole life works. So now, here's the thing, talking to a kid and talking to all of you. Every child understands objects. And most children at a young age are taught a circle, right? And we understand if we have a circle and something is inside that circle, so I'm trying to think the best way to do this. I've never done this before, but right here, if your money is inside of a circle, the one thing we want to do is we want to start your money here. We want it to compound and continue to grow, but we still want to keep our money flowing around because what's going to happen, and I'm going to use a bank account. Even if all of you found a bank account like I did paying you 5.25%, and you put money in that 5.25% savings account, but then you found a really good opportunity to invest in something that you know, like, and understand, you did your proper due diligence, it's a really good investment, and you want to take money out to invest to make a 10% return. So let's just say over here, your money's making 5.25, but over here, your money can make 10. How many of you would take the money out of an account earning 5.25 to earn 10% if it was deemed by you as being conservative or safe? Would any of you do that? You would, right? I certainly would. So a child would understand that 10, because my daughter can count, I don't know how high she can count now, 30, 40, something like that. she knows that 10 is more than 525. And I could also very simply teach her that 10, when it comes to money, is better than 5.25. And you could show her with her little piggy bank. You could take out, 5 singles. You could do this, take out 5 singles, and you could say, here's 5. And then you could take out 10 singles, and you could say 10 of these are more than 5 of these. And you could hold them both up, and you could say, this is more than this. They will understand that. So given that, if to make 5 equal 10, we basically need to take it out, and we need to put it in the place, in the soil. Okay, just keep thinking of the acorn. Just draw the acorn here again. There's your acorn. We need the acorn to be in the best soil where it can grow the fastest. 10% is much better than 5. So we take it out, we put it in 10. Now let's call this a real estate deal. We're going to cover this on the 3-day too. But then when it makes the 10, what do we want to do with the interest that this makes, the 10%? A lot of people are trained because they're going to then take that and they're going to put it back in the regular bank account. They're going to take and put this in a bank account making 525, when what they should do is take that interest and move it around the circle, and around we go. The more times your money goes around this, depending on how old your kids are, hopefully they've learned Monopoly, and in Monopoly, the more times you go around the board, the more money you make, because every time you pass go, you get what? You get money. Every time you pass go. Doesn't that sound a lot like a policy? Every time you go around the 12-month calendar and you get past the policy anniversary date, what does the insurance company from a mutually owned dividend-paying insurance company do? Gives you money in the form of a dividend, which the dividend is not taxable because it is deemed a return of unused premium. Dave Ramsey says that's a bad thing. I think that's the greatest thing ever, because why pay tax on a dividend? You don't want to. So the more times we go around this, every time we pass go, we get paid a dividend. So the more money we can get our money to earn over here, the more times we can get it to keep going around and around, the more we compound uninterrupted. So our money continues to grow. Every year we're adding to that a dividend. Every day we're increasing it on an interest rate. And then every single month, or however you invest, you are adding to the pool, the pot, by taking money from your money working for you. You're not working for this money. Your money is working for you. And it is then being returned back to the original source. But here's the thing I didn't get to. When you take money out of the whole life, it is deemed a loan. You can take a withdrawal or a loan. We'll cover that in the 3-day. I don't have time today. But when we take a loan, let's just use 5% interest. So we are losing 5%. The insurance company is keeping 5% of our, we'll just use 525. So we're making only, in this example, and this is just an example, okay? We're making 25 basis points, or 0.25% spread. So when I was at the bank today, I said something to the girl. Her name was Jen. I said, hey, Jen, I said, do you know how this credit union is able to pay the 5.25% to its clients? And she says, no, I don't. I never thought about it. I said, because the bank buys T-bills at a higher rate than 5.25. And I went to say, and I said, but the bank is being very generous right now because there's not T-bills paying 5.25 today. So this is a loss leader to get people in the door. She says, yeah, I use this rate all the time just to get new people and new money into the bank. It's a teaser rate. So the bank is not making much of a spread, if any spread, on 5.25. So they're relying on making money somewhere else. I'm trying to get you all to think. I'm not talking to a 5-year-old now or a 4-year-old. I'm trying to get you to think about this. The credit union, Cornerstone Federal Credit Union, will pay 5.25 on your deposit, knowing damn well that if the money sits in the bank's coffer or the bank's vault, or even if they buy T-bills, they're losing money. T-bills are like 4.9 something right now. They're losing money. So in order for them to make money, what they have to do is move your deposit somewhere where it makes a higher return. Well, guess what? How much do you think lines of credit are at this bank? Prime +1, so about 8 or 9%, give or take. So let's just round it up to 10. The bank's making 10 by lending the money to somebody buying a house. And then when the bank gets that mortgage payment back, that interest payment that they get for lending the money, what do with it? Put it back into circulation. They put it back here and move it out again. And back here and move it out again. And back here and move it out again. The money just keeps going around and around and around, and the bank makes a spread, but the bank makes a spread twice. Because over here, if they're paying you 5.25 and they're charging, or they're earning 10, they're making 4.75% spread. Folks, I'm just teaching you banking here, but you know what I'm also teaching you? How you can be the bank. It is no different. It is no different than what I just described, that federal credit union that I went to today that I'm moving accounts to. That bank is going to do the same thing we teach you to do every single day with their money, with your money, actually. The only difference between the credit union or any bank and you is they're playing with other people's money. In private banking, what we teach, BYOB, you're playing with your money. But the best part about playing with your money is you never have to answer to anybody. Because it's your money, you set the rules. You set the terms, you set the repayments. You set every single rule for your banking system because it is your money in the banking system. When a bank takes my deposit, they know they owe me that money. There's rules. They got to take this money that I give them. They got to put 10% in a tier 1 account. Okay. Banks have to keep 10% because of the rules in a tier 1 guaranteed account, which is treasuries. Okay. US Treasury bonds. Or can anyone tell me where else banks are allowed to put their tier 1 capital? Who can tell me? Tier 1 capital. Where can they put it? Treasury bonds or treasury bills because they're guaranteed by the full faith and credit of the United States government. You're right. Life insurance, BOLI, bank-owned life insurance. So here, banks are doing the damn same thing I'm telling you to do. But yet we always want to say, oh, yeah, but I heard that whole life is expensive. It's this, it's high commission and that. Well, banks don't give a shit about that because banks got a lot of money in whole life. Called BOLI, bank-owned life insurance, but it's the same darn thing. I'm just teaching you to do what a bank does every single day, folks. And I'm trying to teach you how you can teach your children by just starting with simple things like an acorn or whatever seed you want. But again, I want to preface back to what I said a second ago, and then I'm going to pause and I'm going to answer some questions. If you put that acorn on your desk and it just sits there every single day and you just stare at it, it will always just be this. But if you plant it in fertile soil, if you tend to it and water it and weed the soil around it so that it can get sunlight and get rain, this little seed, God's little gift, will turn into a mighty tree like this one right out here, which is a giant tree. Your money will do the same. Real quick, let's hit some questions and I want to move on to the next segment. What do we got, Stephen?
Let's see. Yeah, Greg just asking about age. So any point of, doing this at 67 years old?
Oh my God. How many of you on here are already doing what we're teaching that are 67 years old or older? Put old in the chat.
Yeah.
Anyone on here right now over 67 years old doing this? Efren's old, so he's over 60. There you go. I'm 65, close enough. We'll go from 65 up. Efren's 72. Okay, James is 59 and a half. David, how is it working for all of you that are 65 years or older? Is it working good? Yes or no? See, sometimes I can just give an answer to a question, or I could just let everyone else give you the answer. You see, we do this for a lot of people. I think our oldest client actively doing infinite banking is, I don't know how old she is now, 75, 76, something like that. Yeah, just learning at 62. Listen, it doesn't matter how old you are. You're never too old to learn new tricks. This is just a new trick. Now, if for some reason you are older and not insurable, listen, do the same thing a bank does. Find somebody that's insurable, take out a policy on them like a child or a spouse, take out a policy, you own it, they're the insured, you control the money. Yes, it won't pay a death benefit upon your death, but you're still helping somebody else by getting a life insurance benefit on them that will benefit their family or your family in that case. Perfect. What's the next question?
Any thoughts on the digital federal dollar? It's coming,
Yeah, I've covered this a lot. I've done many, many YouTube videos on this, and I'll hit it again. Yeah, the digital dollar is coming. No ifs, ands, or buts about it. I don't know when, but this that we know of money, I mean, realistically, think about how we use money today. It's actually sad. We use a digital dollar today. You just don't know it because you still can have access to this. You're like, you feel good because you've got this in your wallet. You feel good because you can go to the bank and take this out. But really, is this how we exchange for goods and services today? No. We use debit cards. We use credit cards. We use Venmo. We use all these other stupid apps that are out there, which I barely use any of them. We are already living in a digital world with digital dollars, folks. It's no different. So what do I think about it? I think it's business as usual. I do have some takes on it that I don't think it's good because it will give the government control over our money. A government will be able to go in there and seize your assets, but they can now. A government will be able to go in there and take your money, freeze your money. And if it ever got too drastic, which be very careful who you vote for. If you didn't catch WTF this morning, you should have, because anyway, I'm not going to go into politics, but just be very careful who you vote for, because that's going to be the future of this country. And how much control do you want on your life? Do you want the government telling you how much, if you own a business, do you want the government telling you how much you can sell your products for, regardless of cost of making those products? Do you want the government taxing you at higher tax rates? I don't think so. So be really careful. What else we got? We got any other in the chats?
Yeah, just one other one I saw that was pretty good. It said, can more than one PMC member invest in a real estate deal?
Well, that is state specific, so that's a great question. The answer generally is yes. Like, I'm just going to use New York. You got to check in the state that you're in whether this is allowed. And it's easy. It's a Google search or just contact a real estate attorney. So in New York, and can I just draw it? It's easier because this is a great question. And I'm going to keep working on how to explain the infinite banking concept to kids. But that's just what I came up with today. So there are two major documents involved in every real estate lending deal that you do or anything you do. Number one is going to be a note. Okay, the note is quite simple. It's just your terms. Think of the note as a useless piece of paper. It is only used to describe the terms. I'm going to lend $100,000. I'm going to lend it at 12% for 12 months. I'll put a 6-month extension at 1%. So terms, that's it. The only person that needs to sign the note is the borrower, okay? So the borrower scribbles their signature. I mean, some lenders will sign the note too, it doesn't matter. But the note, a worthless piece of paper that has terms. Now, the important thing is this other piece of paper, which is called a mortgage, okay? So this, deed of trust, mortgage, whatever you want to call it, is the important one because this is the binding document. This is the one that ties you to the property and puts you on the property as a lien holder, meaning they can't sell the property, they can't do anything, they can't refinance the property until you are out of the way, which should put a big smile on your face. Now, the question you asked is, can more than one person lend on one deal? So here's one deal. Some states only allow one lender, okay? But there are states like New York where I can go out and I can find Stephen, I can go to Brent, I can go to Hannah, I can go to, who else wants to participate in this? Frank wants to lend on this. And then how about Julie wants to lend? And we want to get Tess in on this thing too. So I don't know how many people I just did, but all of these people could all lend on this deal. If it's 100 grand, how many I got? 5, 6, whatever that works out to be, okay? 20, we'll just put 20 grand. I don't know. I got to eliminate a person. So we're going to get rid of you. We don't need you anymore. So 20. Now, how does that work? Well, the mortgage is just going to say $100,000 lien is going to be put on the property, okay? So that's going to make us all happy. But then there's going to be an addendum to the mortgage, and your attorney might do it different where it's going to name all of us, okay? Each of us are named, and each of us are going to share in a 20% first lien. This is a first lien position. 20% each in a first lien position. Okay, so this is allowed in New York. It might be allowed in your state, but you got to make sure you check on that. Was that helpful? Breaking news, this just in. Are you sick of having your money lying around not doing anything? Well, we've got the solution for you. PrivateMoneyClub.com. Back to you, Chris. Heck, that's another thing we're going to be covering this weekend. We're going to be going deep into this. Noah actually is going to be going super deep in how to structure and do private lending to protect yourself. You see, here's the theme. Stephen, can you type this in the chat for me? Here's the number one thing every one of you, all 122 of you, need to be thinking about right now. How do I preserve, protect, and build my wealth? Build, preserve, and protect my wealth. That's the only thing you should care about right now. How do I build my wealth, preserve my wealth, and protect my wealth? Build, preserve, protect. How do you do that? So here is what I came up with this morning. Here's what I came up with. Now I'm going to kind of try to draw this out. I don't have this figured out yet, but let's just take mutual funds, IRAs, Roth IRAs, and whole life plus a mutual fund. All right, so now the example I'm going to do in the 3-day is going to consider somebody investing $10,000 a year for 10 years into a mutual fund paying 10%. So 10, 10, 10. 10,000, 10 years, 10%. Okay, and then we're going to factor that with a 28% tax rate. You can do whatever tax rate you want. So over here, we're going to show every single year. Well, all we're going to do is we're going to show after 30 years, so it'll be a 30-year time frame, 10,000 invested for 10 years at 10% at a 28% tax rate over 30 years. So then what we're going to do is we're going to show the total amount that you've accumulated over 30 years at that scenario, and we're going to show you the total taxes paid. And then we're going to show you every year of taxes. How much were the taxes? Then what we're going to do is the same thing over here. Okay, all the same things, 30 years into an IRA. Now in an IRA, you don't pay any taxes. So what we're going to look at is we're going to really say, okay, what's the difference between a taxed and a tax deferred account? But then what we're going to do is we're going to factor in that when you do want to take money from that IRA, you got to pay a 28, and I'm just going to keep it the same. Now, very, very strong probability the taxes are going to be higher 30 years from now, but I'm just keeping it equal. Fair enough? At 28%. So your distributions, and we'll show this, are going to be taxed at 28%. Now, here's the funny thing that a lot of people don't factor. If you're paying taxes every single year on the growth of this, when you have the money accumulated, yes, it's less than this, but when you're paying 28% on more money, because you're taking distributions out on a higher amount, it's going to be more expensive. So we're going to show that distribution here. Then we're going to do the same thing with a Roth. I don't remember the numbers, but a Roth is going to look the best. A Roth 100% is going to look the best. Now, let me ask a question here to the audience. How many of you have a Roth IRA? Put Roth in the chat. And how many of you are still contributing to that Roth? Put, I don't know, anything you want, plus in there. Because I'll bet, I know Christine, I'm just going to call a couple out. Like I know some of you that are on here. How many of you as a family, your joint income exceeds $230,000? Put yes in the chat. How many of you put, as a family, how many of you bring in more than $230,000 as a family in income? You can't have a Roth. You are phased out. And even if you weren't phased out, what is the amount? I just looked this all up this morning. We got it written down. So Roth phase out. So let's see. What is the phase out range? Let me just share this. And I just want to prove it so you guys don't think that I'm making this up. Here we go. Okay. So here's the phase out range for a Roth right here. Filing status, 2024. If you're single, it's 146 to 161. If you're married, filing jointly, 230 to 240. And if you're married, filing single, 0 to 10,000. That means after that income, you essentially start to phase out how much you can put into your Roth IRA. Okay, now let's look at another thing. Roth contribution limits for 2024, and this is going to go up. So right here, so in a Roth, you can only put $7,000 in and $8,000 if you're over, is it still 50 or is it no? Yeah, over 50. Okay, so there's the rules. So the easiest thing to look at there is how many of you are phased out. You can do a backdoor Roth. Yeah, absolutely, Peter. Okay, so you could take an IRA, fund the IRA, and then move the money and convert it to a Roth, but you're going to trigger taxes, which is really no different because you're going to pay tax on it anyway, but that's a backdoor. So you fund the IRA because there's no phase out, but how much can you put into an IRA, folks? $7,000 or $8,000 over 50. If you got a 401k, sure, you could do that. So there are ways around this, but they're not easy, right? So the biggest thing I'm going to show you is that this weekend, the Roth is probably going to have the most amount of money accumulated as a total, but the majority of the people that we deal with are phased out of a Roth, or this just isn't getting it done. $7,000 or $8,000 just isn't getting it done. And then we're going to show over here, we're going to show somebody putting money into a whole life, same thing, 10K, 10 years, all the same things. We're going to not show them earning 10%. We're going to show a tax rate of 28%, but that isn't going to matter because it's tax free. Okay. And we're going to do it over 30 years. But what we're going to do is in the first year, if we put 10K in, we can probably take 8,500 out and put it in mutual funds. And the next year, we're going to take another 1,500 out. So now we've got 10K put into mutual funds at 10%. Okay. And taxed at 28%. So we're literally going to show you how by just changing where your money goes first and then doing the exact same thing. Because if you put money into a mutual fund and it grows, it's the same as putting money in an IRA in the same mutual fund, because we're just using the same mutual fund at 10%, okay? 10%, and I don't know any 10% that make 10% every year for 30 years, but we're just hypothetical. And then we're going to show the mutual funds with the taxes taken out. And then you're going to look at, after 30 years, what is your net cash value in the policy minus loan cost, okay, loan interest. So we're going to show you this number over here. And then we're going to show you how much money you have in the mutual funds, which is going to be very similar to what you had here, but maybe a little less because we didn't put 10K in all at once. So then you're going to have this. Here's what I think is going to happen. And folks, I don't know. We haven't done the math yet. But actually, let me ask all of you, which one do you think is going to have the most amount of money in 30 years? I don't know the answer, but which one of you think that, what one's going to have the most amount of money after 30 years? David said whole life. Is David the only one that's thinking whole life, whole life? Well, see, I was thinking some of the people would have said the Roth. Because if you ask me, I think under these scenarios, I think the Roth's going to have the most. I do. I don't know. And I'll be surprised if the whole life plus the mutual fund has more, but it might. Because here's the difference. All of these, you're making money one time. You're making money one time on the $10,000. And you're making it every year. Yes, it's compounding. Some of them are tax deferred. The Roth is tax deferred and tax free. So they're all compounding. They're all doing the same thing. But there's only one up here that makes money twice on the same dollar. And that is this one. Because the whole life allows you to use the money without interrupting the compounding. I came up with this today in the shower. And I was so excited. I don't know why I was so excited about it. But I rushed out of the shower and I wrote this on paper because I've never seen somebody do a comparison like this. But how cool would it be if we can mathematically prove this and show this, to be able to show this to your CPA, your attorney, your broke-ass brother-in-law who told you to buy term insurance, that whole life thing is a piece of crap. Which, if any of you haven't been around this campfire for a little bit, you probably did miss something super important, and I'll show you. See, a lot of people don't realize that we're not just talking heads here, not just gurus telling you that this works and that works and selling you some magic super potion. We're literally doing the math right here. We debunked, I don't know, a 20-year-old myth of buy term, invest the difference being better than buying whole life and investing the difference, or investing the cash value, I should say. We debunked it here. It's a heavy, heavy white paper. There's going to be a book that we're going to basically give. All of you are going to have access to this. All right, so this is what we're going to do, and I definitely think this is going to be the best one, but I think the Roth will squeak it out. The only problem with the Roth is most of you that want the Roth can't do it. You know, I know Peter can't, Mark can't, you know, Drew can't. I'm just calling some names out here. Like I already know. I don't even know what you make, but I know you make more than that. And yes, you can do the backdoor, you can do the Roth conversions and all that, but that's a lot of work. You want to do that every single year? No, of course you do not. So this. Also, too, here's another thing that I didn't mention. The Roth doesn't have liquidity like this one does. You see, this one out of all of them, so if I just use my little brown highlighter, this one out of all of them is the only, well, I should say this one too, but this one out of all of them is the only one that gives you pure liquidity of your assets. The mutual fund does, but sometimes mutual funds don't have pure liquidity. But you have pure liquidity, and this is definitely the only one that will provide a legacy for your children. All right, Stephen, anything come out there? Are you assuming that the Roth is invested in this? Yeah, I'm assuming that all of these things are invested the exact same way, and I'm just making up a 10%. I'm using one from Dave Ramsey, right? Dave Ramsey always says, oh, put your money in a mutual fund and earn 10 or 12% forever. Why do you think so many people are mad at Dave Ramsey? It's because he's filling them full of lies. Sounds a lot like the things you saw at the Democratic convention, like just lies. Sorry, that was hitting below the belt. Had to.
And Marie just said, just got their term premiums after 20 years return because I didn't die, but those premiums could have been invested. Jeff said, how about buy term and don't invest the difference?
Oh, well, hold on. Let me hit that. That's great. So right now, I own $1 million in term insurance, and I've owned it for a long time. And you know why I bought term? I didn't invest the difference. You know why I bought it? Because I only needed protection for a period of time so that if I died while we had mortgages on our rental properties, they were all paid off from my family. That's perfect. If you had a car loan and you wanted to protect that car loan, buy a 5-year term policy. If you had a mortgage for 30 years, buy a 30-year term insurance policy. Like, that's what it's designed for. It's right in the name, term, but yet somehow, somewhere, every single guru out there or advisor says buy term, invest the difference is the ultimate. You are screwing your family. I'm trying not to swear today, but you know the real word I wanted to use. You are screwing your family if all you do is protect your legacy with term insurance. 100% screwing your family. Because, well, here, I got to just do this. I'm sorry. I just did a Instagram short and it brings this up. Has anyone ever done this? Go to Google and type percentage of term insurance death benefit that actually pays out. Just Google it. According to Zebra, 99% of term life policies never pay out their claim. Okay, what else we got? More of that. How about down here? Is that Zebra? Here's another one, 99%. And we go another one. Let's see, typically between 10 and 30 years. And if you die during that one's not giving us it. So it doesn't matter what you look at. No matter where you look, it's less than 2%. According to Zebra, it's 1%. Is that what you want for your family? A less than 1% chance that they're going to get that death benefit when you die? I mean, come on, let's be honest with ourselves. But then what they're going to do is then they're going to say, oh, come on, that Chris guy is full of shit. Like, you're investing the difference and you got all the assets that you save up. How many people do you know in your life that have saved up the difference and never spent any of it just because they want to leave it to their family? And then all that difference that they saved up, how much of that is going to trigger estate taxes? Maybe none of it now, but if they roll back the tax credits or the tax laws as they are today, the federal estate tax limits could be 2 or 5 million, not 23 million or whatever they are today. How much do you think you're going to owe the federal government when you die? See, nothing when you die, nothing when your spouse dies, but your kids are going to get a tax bill on your hard-earned assets and hard-earned work that you put in to build your legacy. And the government can take up to 40% of anything that exceeds the estate tax limits, which today are nice and high. Okay, I think 22, 23 million for the family. If it's just single, it's like 14 million. Let's just put it at that. Now, that doesn't account for state estate tax limits. That doesn't count for probate. You want the courts deciding how your money is split up? Well, in New York, if you keep assets more than $50,000, if you keep more than 50 grand in a bank account, it's probatable, which brings the courts and attorneys in to help divide your hard-earned assets up amongst your kids. Get a trust, folks, and I'm going to go to that next, but just get away from probate. And life insurance, just death benefit bypasses probate. Retirement accounts bypass probate. Annuities bypass probate. So we don't need to deal with probate if you just position assets properly. But you're still going to have to deal with estate taxes. Now, how about this? Does anyone want to share something here? I'm going to show you guys something that's going to really, really help a lot of you. Now, I got to do a disclaimer. You all signed for the disclaimer, but if I can just go one step further, I'm not giving you legal advice. I'm not giving you tax advice, and I'm not giving you financial advice. I'm giving you what I'm doing, and I'm giving you numbers right off of Google. Get a good estate planning attorney. If you need one, we have a great one. Ask us. If any of you want our team, it's not even our team, but just the people I use to help you with yours, I can vouch that they're very good. Ask us. We'll give you their number. You don't pay us for that. It's not like they're going to charge you more. It's just, this is who we use. We are happy to share. All right, so right here, 13.61 million single. Okay, actually, let me do this. 13.61 million, and if we do combined, let's see. All right, here. Just so you know, these are set to expire or sunset December 31st, 2025, unless Congress acts to extend it or make it permanent. Hope you're paying attention. I really hope you are paying attention, because listen to this. Pay attention. Actually, screw it. I'm just going to share my screen. I want you to see what I'm seeing. Does everybody see this right here? Actually, here. Let me make it easy. Not that one. 2026. Right here. That's not the one. Where is it? Right here. There we go. I'm going to draw a big circle around something that all of you really need to pay very close attention to. Stephen, you see that?
Yeah.
The exemption, which right now is over $22 million for a family, is scheduled to automatically reset. This is going to really put the faith that you have in your government on the line, because it's going to reset at $5 million, approximately $7 million indexed for inflation. So now let me just ask a quick question here. How many of you have a total estate over $7 million? Put 7 in the comment. And I know a lot of you don't want people to know that. Like, I just, some of you will. Like, I'm going to do it. I certainly have an estate over $7 million. And you guys don't have to put yours in there. I know this is delicate information, but if you do anything over 7 million, if it sunsets and renews and resets, anything over $7 million could be taxed, or your children could be taxed at 40%, up to 40%. So how do you avoid that, right? How do you avoid that 27.22 million? 27.22 million. There we go. All right. So how do you not pay estate taxes? Can anyone tell me how to not pay? So James did. You could move your entire estate into a properly, it'd be a proper estate plan, okay? So let's just write estate plan, but really an estate plan is going to include irrevocable trusts. Now, who can tell me what a bad part of an irrevocable trust is? If you had an estate over 20, here, let's just do 7 million because it's going to reset, or maybe. So if you had an estate over $7 million and you moved your estate, you moved a chunk of your money to get you below the threshold, which to be safe right now would be 7 million. So you move those assets into an irrevocable trust. Just so you know, once assets go in, they no longer can come out. So you have limited, if any, limited to no liquidity, because what you're essentially doing is you're moving your assets, anything above and beyond $7 million, you're moving them into a trust, so they're no longer your assets. They're now owned by the irrevocable trust and controlled by the trust. Now, you can control the trust. You can drive the trust assets to be invested any way you want outside, but every penny has to come back into the trust, and it cannot very much benefit you, but it is outside of the estate taxes, right? How many of you want to give up access and liquidity of your assets by moving them into an irrevocable trust? I don't. I did it and I unwound it. I didn't like it, okay? I'm not saying it's bad. I'm just saying I didn't want it. So can I give you a secondary option? How about this? What if there was a way that you could, doesn't matter what the estate tax limits are or state estate tax limits are, what if you could just do one thing and you don't have to change any of your assets? You just keep all your assets where they are. I would try to get them into something where you avoid probate. And basically one of the other things that you can all do, and I'm happy to share, I mean, I just did this, is you could set up a living trust, and that could be a revocable, which means now, kind of just like how you guys all operate now, guys and gals, like money goes in and money can come out. So now I can move money into the living trust, but I still can take money out anytime I want. By doing this, whatever assets go in the living trust, and the assets that should go in the living trust, so like I'll just give you mine, in New York State, probate starts over 50K. So that means I got to move all these cars. I got to retitle them in the name of the living trust. Bank accounts, I'm going to retitle those in the living trust. I'm going to, basically everything. All of my assets are going to move into this living trust. And now that basically bypasses probate. That's the only purpose of it. But I maintain full liquidity to do everything that I do today. Now, by doing this living trust, here's really the reason you would want to do it. This living trust gives you a voice or a set of instructions when you die. Now, the book, What Would the Rockefellers Do, outlines this really well. And like I said, you'll all be able to get a copy soon. We're going to create a funnel. We're going to give the book away for free or free plus shipping. Fair enough? All of you will get a copy, and you'll also get his legacy workbook, which allows you to create your family constitution. But here's how mine works. My trust is the beneficiary of all of my life insurance. So let's just come over here. All the life insurance that I own, all of my policies, the beneficiary is the living trust. Okay, it goes in here, and I also use an ILIT, but I don't want to get into that today. Okay, but so let's just say it goes into the living trust. Now, let's say that's $20 million that is now in the living trust upon my death. My family, my wife, my kid, my kid's kid, they're all going to have access to this money. But here's how it's going to work, because I had a voice and a set of instructions in place for this living trust. So there's going to be a trustee or several trustees. So we're going to have trustees. They're going to control all the money, okay, the $20 million inside of this living trust upon my death. Larissa, my daughter, anyone in my immediate bloodline is going to basically receive money, okay? They're going to receive an income, nothing crazy, but they're going to receive an income that's suitable for their standard of living. And that income is going to be derived by the investments inside of this living trust, the private lending, the loans, and that will all be managed, okay? Think of this as your family office. That's how the Rockefellers did it. This was managed by their family office. So you can set up your family office so that when you die, that money continues to be invested, lent out. Private Money Club will be a great source for you. So that's where the income comes from. But if there's $20 million in there, one thing that Vivi or Larissa will not be able to do is they cannot go in and take that money. They can't squander that money. They would, if they wanted, let's just say Vivi wanted to start a business. She had this great idea for a business. Vivi has to do a business plan and a loan request. And some of you won't agree with this, okay? Some of you are like, why would you do this to your kids? Well, you would do this to your kids to teach them how not to waste money, how not to ruin a legacy, okay? So this business plan would be submitted to the trustees. The trustees pretty much will be informed based on my instructions to approve just about any loan. So Vivi needs, let's say it's, let's use like, I don't know, there's some other people, like $1 million. She needs $1 million. The trustees approve the business plan, so they give it a big stamp of approval. $1 million is given to Vivi or Vivi's company as a loan. The loan will involve a lien on assets, and the loan will also require, if she's taking $1 million, that she has at least $1 million in death benefit. Now, if Vivi doesn't have $1 million in death benefit, what the trustees will be informed to do, the trust will take out a whole life, a specially designed whole life policy on Vivi in the amount so that $1 million upon her death would be paid back to the trust, because we want to make sure that Vivi is protected upon death for the amount that she borrowed. $1 million, and it would actually be $1 million plus interest. And then that money would be back to the trust. So if something happens, Vivi's business fails. So let's just say her business plan doesn't materialize. She loses $1 million. She couldn't make any payments back to the trust because she would be required, based on the business plan, to repay loan payments back to the trust. But let's just say she made none of them. That's fine, because the living trust will be made whole upon her death. And we all know we're all going to die and go on to heaven. Hopefully all of us are going to heaven. So that's how that works. But let's say she wanted to buy a car. She can buy any car she wants as long as she, and the trustees will be informed to do this, as long as she can afford to make the loan payments for the car. So she could buy a $60,000 car as long as she can make payments on a $60,000 car. The trust will then take out a lien on the car. If she doesn't make the payments for the car, goes defunct, the car will be foreclosed on, repoed, and then the money put back in the trust. These are bad things. But this is how you teach your children how to be responsible. And the best part about all of this is every payment that Vivi or Larissa or anybody makes upon my death, every payment they make back here, this is their bank. They own and control this bank. They have access to the money in this bank. Every payment builds the bank. Every payment that they make makes the bank bigger, so that when they basically have the ability to buy and do and build and do more things throughout their lives. Now, I didn't get to the main point, and thank you all for being patient. I'm going through a lot of stuff here. Remember we talked about that estate tax? So let's just say somebody is worth $40 million, and let's just say estate taxes are rolled back to $10 million, okay? That means this is their assets, this is your estate, and this is the exclusion amount. That means there's $30 million that is subject to taxes, and let's just call that 40%. So let me just do some math here real quick. Is everybody getting something out of this? Now, I know I'm using big numbers, folks, but listen, I'll bet you any money the majority of the folks on this webinar right now have an estate over that. Because I see I'm losing some people, but that's okay, because I'm really trying to talk to a specific group of people here. 30 million times 0.4. That means that the estate taxes on this would be $12 million in taxes. Now, the taxes aren't triggered until the husband and wife die. So if it's a husband and wife, okay, so we'll just draw them here. There's a husband and a wife. So if husband passes away, so husband's gone, the assets transfer to the spouse. I'm just picking on the wife because women live longer than men. This assets, the $40 million estate, passes on to the wife. Nothing changes. But when the spouse passes, the children, now let's just say there's two, brother and sister, okay? The children now get the estate, but now they've got to pay the piper, and they've got to pay $12 million of the $40 million estate. Some of you are thinking, that's not really a big deal. If they got $40 million, like what's the big deal given $12 million? Let's say this $40 million is almost all illiquid assets. It's real estate, it's land developments, it's all sorts of stuff. I'm just making it up. What if there's no liquidity in that? Now the family needs or these kids now need to sell off assets to pay the taxes. That might not be advantageous at all. That might not even be possible. So how about this scenario? What if we took some of the income from this $40 million in this estate? Okay, we took some of that income and we deferred it into what's called a second to die, specially designed whole life policy. Okay, and this whole life policy pays out upon the death of the second person. So the wife. Husband passes, no money passes. Wife passes, death benefit is paid out. I just did this for somebody and the death benefit was 38.5 million. It's a similar, I'm kind of using some numbers from theirs. It was $38.5 million. So now if we took 12 million and subtracted from 38 million, they still get a death benefit. They keep all of the assets. And who paid for the estate taxes? Who paid for the estate taxes? The insurance company, right? The insurance company paid for the estate taxes. Now here's the gripe. A lot of people would be like, yeah, but I don't want to put money into the whole life. Those premiums are going to be expensive. The one I designed, let me just give you some of the stats on the policy I designed. I'm going to come over here. So this is our second to die whole life, specially designed. How many of you want to, so I can't remember how much we did. We did a dump in. I think we did like two mil dump in. And then I can't remember what it was. Let's call it, we'll call it 300,000 a year in premium, which for this individual, because they're a high net worth individual, well in excess of today's estate tax limits, was no big deal. Okay. But here's the thing. They take this 2,300,000 and they put it into the policy and premium deposits, which immediately gives them a death or a cash value of about 1.9 million day one and a death benefit of 38.5 million. So they have immediate liquidity of 1.9 million of the 2.3. That sucks. Well, hold on. Go the next year. The next year, they do another 300,000 in, and now I think they have, I think the second year, they have something like 2.3 or 2.4 million. And here's the thing, by the third year, they put another 300,000 in, and they've got all their money back. Now they are in their 50s, okay? So they're not in their 60s. In 60s, it might be the fourth or fifth year that you get all the money back. But here's the thing, to have the insurance company pay your giant estate tax bill so that your children keep all of your assets is going to effectively cost you money or cost your estate money because you're going to have to fund the whole life policy. But if you had to fund something and you only had to fund it at a loss for a couple years, let's call it 2 or 3 years, and then after that, you pretty much got all your money back, even if it took 5 years and you got all your money back. And then every year after the third or fifth year, you had more money than what you put in. See, when I did it for this client, I did a 10-year, because they're only 50. So after 10 years, they made an average of, and I'm trying to remember the numbers, Craig would have them. I think they made a cumulative return of 10.94% on their money. Did that cost them anything? Did it cost them anything to make sure that the insurance company pays their estate taxes so their kids don't? Yeah, it did. They had to fund the policy, but did it really cost them anything? No. They actually ended up making money. And you know what? They lost very little liquidity of their money. They had a little loss of liquidity year one, a little loss of liquidity year two, maybe loss of liquidity year three, but not much. So they had access to all of their money the entire time. Who wouldn't do this? Would you prefer to do this? Or would you prefer to go out and spend a bunch of money on a fancy-dancy estate plan to move all your money into irrevocable trust and offshore accounts, which you have no liquidity of and you have no access to? It's just, you don't want to pay the government money. Which one would you prefer? Can this second to die policy be used for IBC? 100%. It works no different than the whole life policies we do now, except you're going to get more death benefit because the insurance company is splitting the risk over 2 people. So when one dies, the insurance company doesn't have to pay out that big death benefit. It's not till the second one dies. And if a husband's older than a wife or a wife's older than a husband, the insurance company has more time. So they pay more death benefit. The difference in this case between a single policy on the husband and a second to die was almost $10 million difference in death benefit. So it went from like 28 to 38 million. And no, we don't give these drawings. We can't give you the drawings, but you can watch the recordings on the YouTube channel because we record all of these. So in conclusion, does anyone have any questions on this? I covered 3 basic things. We started with the acorn. We started with the kid, teaching your kids how to be good with money and how to create their own banking system. And it's just going round and round. It's important that they understand the soil and the tending of the soil matters for how fast their crop grows or their money grows. Then we went from there and we moved on to a couple different topics where we were talking about whole life insurance and why whole life, and we were talking about estate taxes. And now we wrapped up with why not have the insurance company pay the estate taxes. Let's see. What is the max age? This is another interesting thing about that question. What is the max age? A second to die, a second to die policy is way better if you're older because you're splitting the risk. So the cash value is going to be higher. Is it FDIC insured? No, that's a bank account. This is insurance companies. Bank accounts fall under FDIC. Insurance companies have a different set of insurances that they have to protect the investor, or not the investors, but the depositors or the policy holders. So insurance companies fall under a different realm because it's not banking. Good question though. But if you research it, you'll find that insurance companies' protections are far better than that of banks. And just look it up. But look up how many, I could even Google it now, but we're running out of time. How many mutually owned life insurance companies have gone bankrupt that have resulted in policyholders losing money? I bet you the answer is 0, ever. Then you could ask yourself, how many people that had bank accounts have lost money when a bank's gone defunct? It's definitely not 0. FDIC is the biggest scam going right now. They don't have enough money. Guarantee Association. Thank you, Tess. Tess used to work for the insurance companies. It's called the Guarantee Association. Look it up. So Stephen, wrap us up real quick. And if you could just tell everybody one more time about what they're going to get this weekend at the 3-day. We still got 105 people. I want all of you to join us. Even if you can't join us live, you need what we're going to be going over this weekend. It is honestly just a rock star layout for what we're going to be going over. The materials that we're covering are all brand new. If you've been to other 3-days, this is totally different, I assure you, except for the opening act. It's totally different. Yeah, Stephen, I'll let you kind of go through and explain it.
Yeah, I just wanted to show, I mean, click the link, you just go here, reserve your seat. I mean, you can kind of look through the page a little bit, but I think you guys probably, if you're on here right now, you probably know what you're going to get. We, we give everything. So all day Friday starts at 10 a.m., all 3 days. 10 a.m. we'll go till, I don't know, probably 3:30, 4:30 each of the days. And like I said, just bringing on all the experts, bringing on people that are very knowledgeable and controlling wealth and different alternative investment strategies. It's basically just a strong financial foundation to be able to, go out there and start implementing, different ways to be your own bank and different things when it comes to real estate investing and different tax strategies and, everything that the wealthy do, everything we do with our money, we just lay it out for 3 full days. And, if you've been watching any of our YouTube channel, social media, coming on these wealth webinars, and you guys probably know, but this is kind of the bet. Sometimes it gets confusing. We give out so much different information between BYOB and Money School and Money Multiplier and the infinite banking concept and all the different things that we do. So it's kind of like 3 days of bringing it all together, bringing it all home for you. And like you said, Chris, what you put together for Friday, I kind of looked through some of the slides and was talking with Craig also, and it's just amazing, just some of the new information and how, we do this every 3-4 months. I think the last one was like 6 months ago, so it's been a while, but amazing how much changes in that short amount of time and, what this looks like compared to earlier this year. We'll be emailing out the registration links for the Zoom for Friday morning, and then we'll be mailing out the recordings with timestamps for the full 3-day, as well as those get completed. So spend 3 days, get those recordings, and set yourself up. And like you said, Chris, it's all about building, preserving, and protecting your wealth. And we're going to get into all 3 of those very deep. And it couldn't come with better timing with the election later this year and what historically always historically happens in election years when you just see a lot of volatility. So we want to be ready for that. And this 3-day training is designed to put you in that position. So really looking forward to it.
I love it. Very much love it. And, I want to do something really special. Somebody just asked where they can ask a question. You can ask a question right here in the Q&A. Even when I stop recording, I'll still answer your questions. But we also have Ask Me Anything this afternoon at 4:30. So you just got to be basically on my YouTube channel or Facebook or even Instagram on any of my channels, and it will come up as a live. If you're not subscribed to my YouTube channel, just go to my YouTube, subscribe, and click the little bell. that'll notify you when we go live. And I want to do something really fun here. And Gilbert, I'll get to your question in just one sec. I want to give something away, and it's not worth anything unless it's worth whatever it's worth to you. I want to mail this acorn to somebody. So the first person that gives me their address in the chat, I will mail you this acorn, and you could use that to tell your kids a story. So first person that gives me the address. Thanks everybody for joining us for this wealth webinar. We'll see you this weekend for the 3-day money school event. All right, so I hope you guys enjoyed that episode. We're putting up tons of them, but I think if you like this one, you'll probably like that video as well. Not only that, I've got a book that I created, Mapping Out the Millionaire Mystery, where we actually show you what the wealthy do in the game they play with money. I want you to have that for free. And if you want to know about all my new videos coming up, click that alert button. Actually, smash that alert button, and you'll be notified every time we put a new video. So we'll see you on the next episode.